Hey everyone, welcome back to EduNudge. Today we are diving into a crucial topic in finance, that is financial markets. Whether you are studying finance or just curious, this is the one you don't want to miss. Ever wondered where companies get quick cash or how we can buy and sell shares so smoothly? That's where financial markets come in. Alright, so let's start with the basics. Financial markets are places where people and companies can buy and sell. They trade financial assets like stocks, bonds, or short-term loans. These markets are crucial because they help the economy run smoothly by providing liquidity and investment opportunities. Think of financial markets like a big mall, just like how you go there to buy clothes, groceries, and gadgets. Financial markets let businesses and investors shop for different types of funds or investments. Let's talk about money markets. Money markets deal with short-term funds, usually less than a year. It's like a place where companies and governments go when they need cash quickly, but only for a short period, where instruments like treasury bills, commercial papers, and certificates of deposit come into play. These are all ways for companies and governments to borrow money fast and repay it soon. So what is the economic role of money markets? It's very simple. They provide liquidity, helping companies stay financially healthy and supporting the overall economy by making sure there is always quick cash available. And of course, these markets are regulated. In India, the Reserve Bank of India oversees the money markets to ensure stability and safety, so businesses can borrow and lend confidently. Now let's move on to capital markets. This is where long-term funds are raised, typically for periods longer than a year. It's the place where companies can raise large sums to grow, expand, and invest. Capital markets are split into primary and secondary markets. In the primary market, companies issue new shares or bonds directly to investors. Think of it as a company saying, hey, we are selling a piece of our businesses for the first time. Initial public offerings or IPOs are a common example here. Then there is the secondary market. Once a company's shares are initially sold in the primary market, these shares are then bought and sold by investors in the secondary market, which is basically the stock exchange. This is where all the trading happens daily, letting people buy and sell shares easily. With so much money at play, we need strict regulations to keep things fair, safe, and stable. This is where security market regulations come into the picture. They help protect investors from fraud, ensure transparent information, and keep the financial system stable. And now, let's talk about the watchdog that keeps a close eye on these markets. SEBI, or Securities and Exchange Board of India. SEBI's role is crucial for market stability. They protect investors, make sure companies play fair, and keep financial markets running smoothly. You can imagine SEBI as a referee in a football match, ensuring everyone follows the rules and no one cheats. They regulate IPOs, monitor trading, and enforce laws to prevent market manipulation. Alright, let's do a quick recap. Today we covered money markets for short-term funds, capital markets for long-term investments split into primary and secondary markets, the importance of security market regulation for safety and transparency, and lastly, we talked about the role of SEBI as the market regulator in India. Financial markets might sound complicated, but they play a role in everything from job creation to everyday investments. Understanding them can help us make better financial decisions. So whether you are a student, investor, or just curious, keep learning. If this video helped you understand financial markets better, you can consider subscribing this channel. See you next time on EduNudge.